Welcome to another video about the stock market. After the last video, I got comments and you wanted to know more about where the stock market is headed. So here's your chance. So focus in and let me tell you a little bit about what the stock market is about and where it is headed. So feel free to watch it multiple times and also share it with your friends and family. All right, so now let's look at some of the basics over here. By the way, disclaimer, this information is for educational purposes only and use this information at your own risk. Okay, so let's look at the basics. Stock market, basically I'm referring to S&P 500. Why? Because it's 500 of the largest US companies and the performance of S&P 500 depends upon the economy. And you could say economy is movement of goods and services, which is actually money changing hands, or in today's world, it is movement of money. Okay, so it's all about money. If the money flow stops, the S&P 500 goes down. So the S&P 500 performance depends upon lots of things, but let's just focus on four important ones. And the reason for this is because these are the biggest ones and these are the most important ones. So let's look at the first one, which is the GDP. And the GDP, again, this is Bureau of Economic Analysis, personal consumption, business investments. Again, you can read this. And I have broken down these into their individual components because I want to also show you what my predictions are for where the GDP is going. So let's move this out of the way right here. And personal consumption, as I mentioned, it's 70% of the GDP, and it can be divided into goods and services. I don't want to spend too much time on it, but the reason I broke it down is you can see what in the current environment, what could happen to these components. And I am giving you suggestion. I'm kind of making predictions as to where it would go. So let me just give you an example. As far as goods are concerned, it is durable goods, which is cars, furniture, large appliances. For 2019, it was 9%, but I'm predicting that it would go down to 3%. So we are losing almost 2/3 of that. Why? Because so many people are not working. So many people can't even go out, stay-at-home orders. Same thing for other things, and this is kind of self-explanatory. Services is also going to go down. This is personal consumption. I am saying or suggesting or predicting rather that this is what will happen. It will go down. Okay. Now, same thing with business investment from 18%, it's going to go down to this. And you want to keep an eye on this. So this is what subtract 5% from the GDP. So that's why when you look at the calculations, it goes to 105, but it's really take 5% off. And again, I'm showing you how each and every component is going to go down. So again, this is the government spending, the last part of the GDP. And as you can see, this is going to go up. This is my prediction. Again, I have looked at lots of data points and we don't have time to go over all these things. As you can see, this subcomponent is blank, but it would have cluttered the PowerPoint. That's why I took it out. But if you look at how much stimulus is coming in and what government is going to be spending on, so you will see that this number is going up. But overall, if you add up all the personal expenditure, the government spending, as well as the business spending, still my prediction is the GDP is going to go down by 18%. And there are other people that have made predictions, and we're going to go over that in a little bit. But here is what happens when the GDP goes down. Okay, so if you see, look at, let's just focus in on 2008, 2009. Here, the GDP, if you see, this side is the GDP side over here, this side right here. So the GDP side. So GDP went down almost like 4%. And guess what? The stock market went down. If you look from here to here, the S&P 500 went down almost 60%, okay? 56, 58, something like that, almost 60%. And what was it? The GDP went down by what? Only 4%, okay? So the GDP was negative 4%, okay? For 2008, 2009, and the stock market took a huge hit. So from here to here, it's 60%, but if you see over here, it's coming up as 40%. That's the year-over-year change, okay? So even if we go by this, which is 40%, so a 4%, when the GDP is minus 4, the stock market is going down 10 times, okay? And let's look at what the predictions for GDP are from other sources. Goldman Sachs, they say GDP is going to go down 34%. Earlier, they had estimates of 10, 24. Now their latest estimate is this. My calculation is 18%. And as I mentioned in the previous slide, it's 10x. So how low will S&P go? So stay tuned, because I'm going to look at some other data points, because I don't want to just look at one thing and say, hey, this is what's going to happen. But let me show you other things so you can look at it from multiple points of view and then decide, okay, it makes a lot of sense. Okay. So the next variable that I was talking to you was about the unemployment rate. Okay. So let's look at the unemployment rate again, looking at 2008, 2009. It went up to 10%. S&P 500 dropped close to 60%. Okay. Now let us look at the 2002, 2003, where the unemployment rate went up to 6%. Stock market went down almost 50%. Okay. So see, we are talking about unemployment rates of 6% and 10%, and the market is tanking big time. And what are the predictions or projections by pundits for this 2020 coronavirus crisis? JP Morgan says the unemployment rate is going to be 8.5%. Goldman Sachs says 15%. Federal Reserve says 32%. Great Depression, this is the Great Depression that a long time ago, the unemployment rate was at 24%. So according to Federal Reserve, this is going to be even worse. So again, the question still remains, how low will it go? But there is the good news, which is in the previous recessions, the government didn't act fast enough. That's what was one of the problems. But the government is acting fast now, stimulus. Plus, the Federal Reserve is also acting really, really fast, which is the 0% interest rate, quantitative easing, which is the government is basically putting more money in the stock market. Okay. So what is the effect of QE on stock market? So as you can see, this is the Federal Reserves of all over the world, Fed, which is US, ECB, European Bank of Japan, they're putting money into the market, so the blue line. And whenever money is there, guess what? The stock market keeps going up. But you will also notice, like 2008, this is when the money started coming in, when the market has already tanked big time. Okay, it had almost reached the bottom right over here. But we are lucky in 2020, the Fed has already started taking steps. So what does that all mean? Let's look at this. So the bad news still stays, the coronavirus is still here. Okay, the reason why the market started going down was because of coronavirus. Okay, so that is still here, and unless we see the numbers going down in terms of coronavirus, the number of people dying, the number of people testing positive, the market is going to keep on going down, because guess what, that was the reason why the market was going down. Okay, so even in the government stimulus or the Federal Reserve um, throwing money at it will not help unless people see clarity. So guess when people don't see clarity, what happens? People are not going to spend money. Look at what happened to the, you go to grocery stores, toilet papers, Kleenex, Clorox wipes, Germex, all these things are not in stock. Why? Because people are scared. So unless this coronavirus thing goes away, or there is a significant change, meaning the number of people having coronavirus or the number of people dying, it goes down. Unless that happens, the market is going to keep on going down. Doesn't matter the government is throwing money at it or the Federal Reserve throwing money at it. It will not happen. In the worst case scenario is it could turn into this. I mean, but of a different kind, not countries fighting each other. It's biological warfare. Like, some of the rogue actors could look at it. They could look at it and maybe look at it as an opportunity to hurt countries. Okay, I don't want to point fingers at any countries, but if you want to look at it, look at the stock markets of different countries, you will get the idea. So bottom line, what I am thinking is this S&P 500 will go down at least 50%, if not more, looking at the previous data that I gave you, okay? Especially the GDP, the unemployment numbers. But here is also another thing. The market don't usually go up or down in a straight line. If you look at, this is 2007, 2009, if you look at that time period, market goes down, down, I mean, down and up and down, then up, then down, then up, down, up, down, up, down, up, down. So if you look, this actually did it so many times. So it's never a straight line. One could argue that in this day and age, people, can trade stocks over their phones. So maybe things will happen faster. Yes, they will. It could happen faster, but still we have quite a ways to go as far as the market reaching bottom is concerned. So here is another picture of the bull markets and the bear market. Let me move this a little bit. So if you see over here, even when the market went down 60%, I mean, it took actually 5 years for it to do that. But another like 4 years, it came back up. Recently, you see this one over here, 2009. It took almost a year and a half for it to drop this much, but still, we went up this much. Okay. So you could argue that, it doesn't matter what happens to the stock market, it will still go up. Even if it goes down 50, 60, 70%, it will still go up. Okay. But let's look at, we don't want to be too complacent about that. Look at Nikkei, which is Japan stock index, stock market. It went up to close to 40K, 39K right over here. And that was sometime in 1990. And we are, guess what, 2020, and it has not gone up to that level. So technically, Nikkei is still in a recession. Okay. Do you think that could happen to the US? Hopefully not. I mean, this kind of looks like a bubble, right? Went up, and then that's why it never went down. So hopefully that doesn't happen to the US, and we come back as we have been coming back in the previous downturns in the market. So what do we do? What the conclusion for this is, if you are trading, be very, very cautious. Do not hold on to anything for too long. I actually don't like to trade stocks, so that's why I give you ETFs. So look for quick profits, get in and out. Puts and calls, if you don't know what puts and calls are, Google them. There are tons of good resources online which can give you more information. So basically you could sell calls, sell them, but I'll make actually another video about this as to when to sell calls. You could even sell calls or even buy puts. So the money that you'd be paying to buy puts, guess what? You're covering by selling calls. So basically you are doing the trade without putting your money in it, and you could get good amount of money uh, as the market goes down. Okay. And as far as investing is concerned, be conservative, buy BND, which is the Vanguard Total Market Index Fund. And also in a few days, I'll make another video where I will give you more details about different bonds. Because bonds, even though you don't make money, but this is the time, instead of holding money in cash, you could put that in bonds, and I'll give you some of the leveraged bonds. If you watch my previous video, I'll include the link below this description. And there I was talking about ETFs that are leveraged, that are, TQQ is the one for NASDAQ, three times NASDAQ. So similarly, there are ETFs for bonds which are leveraged. So you could buy the bond, so this way, you have the money, but your cash is put to work. And you could start to buy a little bit of TQQ, but only after it falls below 35, because I still feel there is a lot of room. So in conclusion, just be cautious, just because, let me actually quickly go over here. See, this is very important. Like, burn this in your psyche, because this is what, see, when the stock market goes down, then goes up, goes down, goes up, that creates a false sense. People over here might have been thinking, wow, the downturn is over, and they started buying. Guess what? So this is greed, fear of missing out. And then when it starts going down, that is fear. Okay. So even if you want to invest little at a time. And when the market goes down beyond 50%, then you can get more aggressive. Okay. So thank you for watching, and I will create more videos and explain to you in my future videos how you could retire just by putting $1,000 a month in TQQ. By retiring, I mean making $3 million in the stock market. So this way you pay $1 million to Uncle Sam, taxes and stuff. 2 million you have left over. And even if you are making 5% on that, which is $100,000, I mean, I think, for me, it's okay. I can live. So I will give you strategies. And again, it is scalable. So if you feel that you can invest more, so you can do that. So I will create that video as well. So retirement video, another video about how to trade. I'll give you simple tips and techniques. So thank you for watching, and feel free to watch it again and again, and feel free to share it with your friends and family as well. Okay. See you in the next video. Thanks. Bye.